Hello, everybody. It's June 1st. I'm Tori, co-founder and CEO of Equi. Today, I have with me everyone's favorite Chief Investment Officer, Itay Vinik, my co-founder. We have an action-packed update. There's been a lot happening in markets, so I don't want to waste that much time. Itay, what do you got for us? What's been going on?
Thank you so much. It's really been an action-packed month, and it was almost like I barely even had time to prepare the market call just because everything was so action-packed. But at the same time, I feel like I have to prepare the market call, right? Because we have so much to cover. I know we all heard about the debt ceiling and all these other big news events that are in the news, but today what I want to dig into is the things you're not being told in the news and how that actually relates and what could happen in markets. Because what we're seeing here in 2023 is just astonishing.
You know, it's always interesting how I feel like the news will tell you one thing, and then what I love about talking to you is you're like, here's what the news won't tell you, here's what's actually happening, and here's what the data is telling us.
That's exactly right.
So what's the data telling us?
Well, let's just hop right into it. So um, we're going to start the share.
Mhm.
And again, Equi market update June 1st, 2023. Can you believe half the year is already gone? I can't believe it.
Time is flying. Like I said that to someone today, and I was like, I don't understand how we're halfway through the year.
It's just not possible. It was just New Year's like 2 days ago. Um, so what we're seeing in 2023, the theme is continuing to happen. It's really a winner take all type of market, which we haven't seen in a very, very, very long time. 2022 is quite different, where everything was going down, bond, stock, etc. 2023 so far, the broader stock market is up, but we're going to cover that in more depth. But it's really a winner take all. So we call this, or I would say B of A has the credit in this case. They call it America's Magnificent Seven, that are up 70%, and in the S&P 500, where the rest of the S&P, the other 493 stocks, are only up 0.1%. It's just astonishing. The market's up roughly 9% as a result of this, and it's a complete winner-take-all market.
It's really wild, and I love the branding. You know that they got to come up with something.
Right, the Magnificent Seven. Just to give you some context, end of May, we had NVIDIA earnings. NVIDIA latest incoming to the $1 trillion club, most increase of market cap in a single day ever recorded. So nearly a 200 billion market cap jump, which is greater than anything Apple, Amazon, or Microsoft or Tesla has ever done. To put that in
Oh, I was going to say it reminds me of Tesla, like during the peak of like the boom when everyone was seeing all these crazy market action with Tesla, but I didn't realize that it actually made Tesla look small.
No, exactly. To put that in context, right? So NVIDIA is a $1 trillion company at this point, but the 184 billion added in earnings is more than an entire Qualcomm, almost 170% of an Intel, more than a whole Texas Instruments. So just to give you an idea of what that AI is making markets go. So we're going through a full on, some would call it an AI bubble. Some would call it an actual technological transformation taking place. But NVIDIA is really at the forefront of AI. And as a result, there's just huge, huge rush into the AI stocks.
Of course.
The $1 trillion club. NVIDIA is the newest incoming member of that club. Nice club to be a member of. Very few companies in the world have achieved that status. Apple is approaching 3 trillion at this point, which is just, again, stunning.
How long do you think they stay a member of that club?
That's very much TBD when you're moving 200 billion a day, right? It's quite a bit of volatility. But to put this in context, it's very rare for these things to actually happen. When you're looking in market history, there's just been very few instances of these type of divergences in markets in general. So we can see that the FANGs are up 63% as of June. leading the NASDAQ itself to being up about 30% for the year, which is again stunning. While the Russell 2000, which is the broadest measurement of the stock market, is flat for the year, just completely flat. Again, it's very, very unlikely. Multiple relationships are now being broken. NASDAQ typically has a relationship with rates, with long-term rates. And that makes sense because tech companies are typically valued at a high multiple. That multiple is very much impacted by the prevailing interest rate. So typically, if rates are higher, you're less likely to pay a high multiple. Money goes away from tech stocks into bonds. And usually when rates fall, it makes more sense to chase growth because there's no alternative. So you might as well buy growth, and multiples for growth increase. But this year, there's been a complete disconnect and break of relationship between the NASDAQ here in orange and the bond market here in white. And that relationship was very strong throughout all of 2022, 2021. Complete break of the relationship over the last 4 or 5 months. Another way to see this is the ratio between NASDAQ and Russell. So again, high tech versus the broader market, and the real rate being paid. Again, a complete disconnect in their ratios. And the biggest argument right now is this a permanent break, or is this some type of temporary divergence, and eventually markets will go to being priced according to where interest rates are. You see this again. This is a repeating theme. You're seeing this in the spread between the S&P 500 and the S&P equal weight. So what does that mean is that if you give each member of the S&P a vote, one vote, versus the weighing them by market cap, you would see that the equal weight is actually flat to down for the year, where the S&P is up nearly, it would actually be down 1.2% for the year, when the S&P is roughly up 9% because of those effectively seven stocks. Why are we measuring this, and why is this so important? Because historically speaking, markets have not been able to sustain gains when there was not enough broader participation. When it's just a few names driving it, it's more difficult to maintain the lead. Because imagine if there's risk events or something happened to just these few stocks, it won't be enough to hold up the whole market, which is why paying attention to the leadership and the breadth of the market is very important.
That's a really big divergence. I didn't realize that had happened.
It's crazy, and you can see how narrow it is. Just 29% of stocks are outperforming the S&P itself. That's actually the lowest we've seen since 1999. Because typically in a normal market, 50% of stocks are going to do better than the index, and 50% of stocks are going to do worse than the index, right? So it's pretty rare that only 29% is actually doing better than the index, where the majority are actually doing far worse. Okay, so the biggest question that I keep hearing is, can AI turn into the .com? Is that as transformational as the .com? So I know a lot of people weren't there to understand the narrative of markets at that time, and we're happy to discuss that. But what's really interesting, in the 1990s, there was this narrative where the internet is truly going to revolutionize the world, and it did, right? There's no doubt about it. But market pricing got way ahead of what that underlying change was, got years ahead of it as far as pricing goes. And even though the transformation really did happen, there was a famous 90% crash in the .com when the .com busted. And the question is, are we developing a full-fledged .com type of price action with AI? Which, again, I'm not an expert for technology, Tori. I think you're more likely to answer that than I am. Is AI as transformational as what the .com was? Is AI as transformational as the internet itself? I actually don't know the answer to that.
I think whether it is or it isn't, I think that what we are seeing is more likely a bubble than it is true transformation, because transformative technologies take time to work their way, through the economy. It's not an overnight change, even with the amazing adoption that a lot of these tools are getting. when you look at something like Nvidia, where they're primarily, I mean, yes, they have diversified revenue streams, but they're predominantly a hardware company. They have hard costs. And, for them to be priced the way they are, to me, doesn't make a whole lot of sense.
Right.
So I do think that, I think it could be transformative over the long run, but right now, this feels very bubbly.
So I don't disagree. However, what I would say is that bubbles can last far longer than people realize. So a couple of things. Alan Greenspan made his famous irrational exuberant speech. I believe it was 1996 or 1997. He was he already thought it was a bubble back then, right? And it just kept going until the peak in 2000. And then, of course, the biggest question is 2022 similar to 1998? In 1998, the market dropped 20% because there was a couple of crises, primarily LTCM. So is LTCM SVB? And if that's the case, this is just getting started. So even though it's a bubble, that bubble can last for a while. To that point, you can see a comparison between the 1998 start point and 2022. Yellow was the NASDAQ of back then, and blue is the NASDAQ today. So if this does turn into a full-fledged .com bubble, believe it or not, it still could be in the very infinite, like the very beginning of it, if that is the case. But what's interesting, we're even front-running 1999, 1998 right now. The market is actually doing better than it did coming out of 1998. So really interesting. I think back then as well, there was a lot of breadth issues. It also was a winner-take-all type of market. The broader market did not participate with the technology companies, and all the money was chasing the high-flying .com stocks. So there's a lot of parallels to what happened back then. But to that point, there's a few differences as well. Some of the differences you see here, a few differences really. First one is rates were low back in the late 90s. And as the Fed eventually tightened them up into 2000, the market topped, where here it was ahead of it. Then the second, when you do see, this is an interesting measurement of when the tech sector outperforms the broader market by that much. We've only seen that actually at the top of the bubble. So again, that doesn't mean that the sample size here is obviously very, very small. So it clearly doesn't mean that we can take that much weight out of this indicator. But at the same time, we do know that it's very difficult to sustain a rally without the broader participation of the market. And we'll cover liquidity later today, which I think is very, very important also when we talk about this. And then clearly valuations do matter eventually, right? They may not matter today and they may not matter tomorrow, but they matter eventually. And the last time the NASDAQ traded at 8x small caps, it did not end well. That was literally the top of the .com bubble.
Yeah. So, and I think at that period of time, were we in a tightening credit cycle, and did we have all the debt issues that we have today?
We were in a tightening cycle. The Fed actually did pop the .com bubble as they raised rates into 2000 to roughly similar levels. The debt today arguably is substantially worse. So we have a much greater debt burden than we did back then. But what we didn't have is coming from the back of decade plus of easy money that I think gotten people psychologically used to very different things, where some of these potentially recessionary outcomes, I don't think is getting discounted nearly as much, just because people have gotten so used to the good times, right? It's reflexive behavior where the Fed eased every time there was an issue. And I believe a lot of investors still believe that if markets suffer enough, the Fed would ease. And I still think this is the going belief. Even though, believe it or not, we're at a 5% Fed fund rate, which is just crazy.
It happened very fast.
It did indeed. Okay, so I'll change topics to the debt ceiling. There's been a lot of discussion about the debt ceiling, and there was some real concern that there wouldn't be an agreement. And you can see that in the US credit default swaps, which is a contract that ensures the default of the United States on its debt. So that was '08. Here's that 2011 debt crisis issue. And look how high we got just ahead of that crisis. There was a huge grab for insurance in the event the US wouldn't pay. But as we all know, the House already voted to approve the deal, and it looks likely to go through. And those prices have completely collapsed. So it looks like default is going to be averted, at least for now, even though it didn't completely go as low as you would think. So some people are still holding on to that insurance just in case. But this is clearly, this would have been a huge issue if it wasn't resolved. US credit would be downgraded. And of course, it's June 1st. If this deal wouldn't be reached, the US would run out of money by June 5th. So again, a little too close to comfort for the world's, quote, safest borrower.
Yeah, they really cut it close. They tend to like that. It's wild how politicized an issue like this has become.
Right. When both parties should clearly agree that default is not in the interest of anyone, which is really not. I don't think we can afford anything close to that. But at the same time, we've seen this movie so many times before. Since 1941, the debt ceiling has been increased 100 times. And you can see this going back, 1980s. Under Trump, the debt limit was suspended for a period of time. The last real debt ceiling drama was in 2011. And then COVID happened and really exploded US debt. So now we're already sitting at 31 trillion with no end in sight. It's really a farce to think that it's not going to be increased, because the level of deficit that is being run and the level of debt increases is just dramatic. And I would even say it's a bipartisan issue as well, because under both parties, the debt ceiling has continuously been increasing. And that's just something that has been going on for years.
Yeah, we need to figure out who the next Clinton's going to be, and not from a Democratic or Republican perspective, but from a who cares about balancing the budget.
So it's funny enough, but I think there was a lot of macro factors that happened during that time that contributed to the surplus that are actually an external shock. It was really the era of globalization, the fall of the Soviet Union, and the technology boom that increased tax revenue, all happening at the same time, that really caused a lot of those dynamics. And again, people think that it's all about politics, but there's all these external factors that influence these things that are completely out of the realm of whoever's sitting in the White House at that time.
Yeah, well said.
So about liquidity, I think liquidity at the end of the day is the most important factor. We're talking about AI and all this rush to AI stocks and all these things that are happening. But at the same time, liquidity drives asset prices for the most part. What you're seeing here is a relationship between the S&P 500 and the Fed balance sheet itself. We had that bump in March post the collapse of Silicon Valley Bank because of borrowing that happened from the discount window because of the banking crisis. And then the balance sheet has dropped a little bit and the market is gradually coming up. But again, remember, even this move up is driven by 7 stocks. If they were not there, we would probably be right around where the balance sheet is implying us to be. So that's been a very strong relationship. There's also M2 money supply itself that has a strong relationship with asset prices because the amount of money in circulation keeps growing. However, we've been in the first period of time since the 1930s that the money supply itself is contracting. So again, this is why I think 2023 is just so interesting for macro, because we're seeing all these factors that we just didn't see for many, many years. Here in '08, money supply growth just slowed. It didn't even decrease. It just slowed. It exploded post-COVID, which shouldn't surprise anybody with the inflation we got after, because turns out when you massively increase the amount of money in circulation, you get inflation. Who would have known? And then now we're seeing the money supply falling, and that's actually quite rare. That's very, very rare. And I think it's much more meaningful than a lot of people realize. And this is a very long history of M2 money supply, going back really to the Civil War. And you can see that this is the first time money supply itself is going negative since the Great Depression.
I didn't realize that. So it looks like, what we're seeing here is all the way back to 1868. And there's actually only a handful of instances, 5 previous instances where it went negative. And until today, with the last being the Great Depression.
That's right. So I don't want to draw massive conclusions from that, because that was the pre-war period. And the Federal Reserve actually, so the Federal Reserve was created in 1913. And then, this is really the first time this is happening in the post-war period. It's really remains to be seen what happens. But history does warn us that a contraction in the money supply itself typically ends with some kind of financial crisis. So this is just something in the back of our mind to put us on high alert until at least money supply starts growing again. But for now, liquidity seems to be going the other way. The banking crisis is continuing as well. Bank deposits are being reduced massively, and that impacts the money supply quite a bit, because the way it works is we're in a fractional banking system, right? So when banks are sitting on more deposits, what would they typically do, right? They want to make money on these deposits, so they lend those out, right?
Mm-hmm.
However, one of the issues and what brought down Silicon Valley Bank is that you can get 5% risk-free in treasuries. So why are you keeping your money in a bank that gives you barely 1 or 2%? Because they can't afford to pay the 5%. So money keeps coming out and sits in treasuries. And as that's happening, banks are lending less money. If there's less money slushing around the economy, guess what happens to the money supply? And then eventually that leads to pretty bad outcomes, but at least historically speaking.
Got it. So that's interesting, and we think about money supply. I mean, conceptually, what's interesting here is, we haven't really, I guess, operated in that many environments where the money supply is contracting. So we don't have a lot of data to go on, right?
That's exactly right. But what we would know, though, is that it would likely not be as, more money supply is typically inflationary, and contracting money supply should be eventually deflationary. So it should work in cooling down inflation, but what else is it going to do? Which is why, I think that this environment is somewhat different than the late 90s, where, you do have this AI hype at the same time. You're having such contracting macro factors that it's a very interesting environment. And I think a lot of people just don't realize what's happening to the macro environment, and they just go based on recent history, because there's a very strong recency bias in investor psychology.
Yeah, no, that makes sense.
Now, this is, I believe, the second most, or after M2, this should be actually second or third most important chart, because the Fed balance sheet is clearly very important as well. But this is the Treasury cash balance. So we all heard, the Treasury is only left with $50 billion. And on June 5th, they're going to be at zero and the US is going to default. Very true. However, the amount of money the Treasury sits on fluctuates. There's periods of time where they spend money. So here the low was around December, and then they spend the money they've accumulated. And then when they get close to zero, they need to replenish that. How does the Treasury replenish what they have? There's 2 ways, right? There's money they collect in taxes. However, this year, by June, they've already spent all the money that was collected in taxes. Pretty unfortunate. And the other way, what they do is they have to issue bonds and notes, because they have to borrow the difference. During the QE period, so this is where the plumbing of all of this gets really interesting. During the quantitative easing programs, the Fed was creating money out of thin air. And that money that was created out of thin air was the one buying the bonds issued by the Treasury. So the Fed themselves was printing money and filling that Treasury account.
Got it.
That made it so that even when the Treasury was issuing bonds, liquidity was not getting drained out of the system, because the Fed was supplying it. Because otherwise, what's going to happen is when the Fed issues bonds, someone's buying it, and that money's coming from somewhere, typically the stock market or other liquid assets, or even bank deposits, because there's a finite amount of bonds. So as that happens, liquidity actually gets drained. So it's a little counterintuitive, because as the treasury cash balance increases, the liquidity to get it there comes from the broader economy, and liquidity actually drains. That did not happen during QE because the Fed was supplying that liquidity. But now it's a double whammy, because the Fed is doing quantitative tightening and they're destroying $95 billion a month. And at the same time, the Treasury Department is going to, so they already released the numbers. In the next 4 to 6 months, they're going to issue $1 trillion worth of bills and notes. That's going to act as one of the largest liquidity sucks we've actually seen, because it's a combination of declining M2, declining bank loans, increase in the Treasury cash balance, and quantitative tightening all at the same time.
So when we look at this chart, and you said it's one of the most important, what time frame are we looking at here?
So this is the last 6 months, and not a surprise that as the Treasury balance was drained out, it actually boosted stock prices. So stock prices did better because as this drained out, it actually countered the Fed's QT. Interestingly enough, right? But now it's going to go the other way. So this is something that I think is you're going to be interested in. This is our own Equi proprietary liquidity model, in which we take the data from the Fed's balance sheet. We take a lot of this liquidity information, and we take the Treasury General account, and we put it all together. And you can see that that's net liquidity is in the red line versus the stock market here in blue. What's really interesting is post the global financial crisis in 2008, this became very, very, very important, as it wasn't that important prior to 2008. So before 2008, 2009, market was moving on, things like earnings and real type of real events, right? But ever since then, it appears to be driven very strongly by liquidity. In fact, this is running a more than 80% correlation with the return of the S&P 500, as liquidity has just become such an important factor. And when you put the quantitative tightening, you put the Treasury General account, you put them two together, you're seeing effectively all the liquidity added in COVID projected to be taken out in the next 6 to 12 months. So we're looking at that, and we're looking at the return of the S&P, and this is the chart that gets us very worried.
Got it. Yeah, that is so we've got this nice kind of gradually rising, little bit of fluctuating, huge rise, and then it appears that we're about to fall off of a cliff from a liquidity standpoint. And if that correlation stays at 80%, like it has been since the GFC, I guess that's where you're taking us next.
Right, which leads me to a very speculative prediction. I believe that at some point in the next 6 to 12 months, if this comes to fruition, the Fed is going to end their quantitative tightening programs.
It's a big prediction.
I don't think they're going to have a choice. Because if they don't, the liquidity suck is just going to be too much.
Well, so walk me through the, what's the series of events that you think leads to them getting to the point where they have to fold? What ultimately creates the pressure?
Credit crisis, multiple bank failures, and stock market 30% lower, 25-30% lower. I think that series of events would basically make them fold.
Wow.
If that happens.
Okay. And what's the soonest you think that could happen? And then, I know we said 6 to 12 months, but like, what's the soonest you think it could happen? And then, what would we realistically expect?
So again, this is where this AI comes in. And I think that's put a little wrench in this, because it creates this reflexive loop behavior. It really remains to be seen. Prediction is difficult, especially when it comes to the future.
Yeah.
And John Maynard Keynes has very famously said that the market can stay irrational longer than you can stay solvent. When he was very right about macro projection, right? His story is interesting. 1919, he went to the Versailles conference where Germany surrendered to the Allies. And the Allies made Germany pay for World War I, and he said they have no ability to do it. They're just going to print money, and that's going to cause hyperinflation. So he shorted the Deutschmark, and then the first year and a half, the Deutschmark goes up because people were expecting Germany to recover. And we all know about the famous hyperinflation of Weimar Republic.
Right.
But he literally went bankrupt before that happened, and he had to get out of his position.
Well, I mean, they say if you're wrong with timing, you're actually just wrong.
Yes, exactly. So it is difficult to project this because you see there are periods of time, for example, here where liquidity really drained, but the market went up for other reasons. At that time, there were tax cuts going on and markets were going crazy. Eventually, things did crash to where liquidity was, and liquidity expanded again. That was actually the COVID crash. So again, it's very difficult to project this, but I would say what the yield curve is showing us about recession and what historical parallels are showing us, I would say the next 6 to 18 months.
Got it. All right. Well, it's going to be an interesting 6 to 18 months then, to say the least.
Indeed. And then back to that question then, so is a recession still coming? The biggest issue we've had is that recession is kind of lingering on. The economy is still resilient. The job market's still resilient. And we talked about that yield curve spread, the spread between the 2-year and the 10-year. It's still heavily inverted. And typically when you get to a strong inversion, that always leads a recession, or almost always has led to recession, especially in the post-war period. So again, 1982, inversion, recession, 1989, inversion, recession, 2000, inversion, recession, 06, we know what happened after that. So we're in the same spot right now. And typically you're really getting ahead of the recession when the inversion starts to come back in, because then you're pricing the future normalization. Then the market starts pricing the Fed pivot or the Fed rate cuts, which typically happens as the recession starts. So then the 2 years starts to rally. So we actually are starting to see this move. We're starting to see that rounding. It really happened post Silicon Valley Bank. That tells us the recession is probably fairly close. I would say within 6 months, it's very, very, very possible. There's other sort of pieces of evidence. No Fed tightening cycle have ever ended without something breaking. So far, Silicon Valley Bank has broke. The biggest question, and of course, Credit Suisse. The biggest question is that it, or are we going to get bigger things to break? It's funny enough that even the 2019 period ended up with COVID, but I think it would have ended up in a recession either way. In a way, COVID actually prevented a recession. The 2007 hike cycle ended with subprime and eventually led to Lehman as rates actually were cut. 1998. The dot-com bubble bursted on that tightening cycle. So it's interesting to see where we're at, but typically a combination of a lot of debt in the economy and rising rates eventually breaks something, because monetary policy does work in a lag. So we're still waiting and seeing how that's going to look like. High yield bonds, basically the rate in which the riskiest corporations are borrowing money, is really high, meaning the price of the bond is really low. Historically, these credit spreads are a good leading indicator. And right now, they're not trading well at all. They're trading very, very, very recessionary. And real estate. We're seeing a lot of stress in the commercial mortgage-backed securities market, potentially indicating on a pretty substantial real estate crisis. And a big part of it is going back to that bank story we talked about. 60-70% of commercial real estate loans actually come from the small and middle-sized banks. And if all those deposits are flying to treasuries and they get less and less deposits, then that freezes the real estate markets, causing a lot of issues. Not to mention, there's going to be huge amounts of bonds and loans that are coming due with low rates that need to get refinanced into the much higher rates of today. Mortgage rates are nearly at about 7%. Again, that puts a ton of stress in the real estate market, particularly office. Office is a huge issue, as there's still not been anywhere near the return. Offices are still about 50 to 60% occupied versus the pre-COVID levels.
Yeah, no, we're seeing it. I mean, the hybrid is the new in person.
Right. Right. And then you don't need nearly as much space. And yeah, so we're seeing that there as well. GDP, not really going negative yet, but definitely decelerating. So we're hugging the zero line here. The forecast is that we could see some negative prints over the next few quarters. Remains to be seen. This obviously the COVID one, but again, still remains to be seen.
Yep.
Leading indicators, right? So these are things that lead the economy, right? You have various types of indicator, lagging, etc. This is the leading indicator. Leading indicators are actually rolling over quite hard in a way that is usually just ahead of a recession. So we've been waiting for that to happen. This is happening now. And you can see payroll following that, kind of rounding out, but not really doing it yet.
Yep.
A leading indicator for payroll is actually starting to roll over quite a bit. So this is temporary help. Temporary help typically rolls over ahead of actual full employment. We're seeing that happening now as well. So LEIs rolling over quite a bit. Temp work starting to roll over. All of them are very similar to prior cycles.
And I'm assuming LEI is leading economic indicators.
Yes. Yes.
So would you say, I mean, just looking at some of these charts and hearing you talk through it, it sounds like this is following a pretty standard recession playbook. Like, I know that there's the AI boom, which is unusual, but from the data side of things, it seems, I mean, what do you say? Is this like standard playbook that we're seeing here, or what's different?
Sort of, but not exactly. What's different is the consumer psychology, I think, because people's recency bias has made them save less and spend more. The consumer is still somewhat resilient. They're used to a lot of government assistance and they're used to easy money policies, would be my theory, right?
Yeah.
And you see that here. So Royal Caribbean says that occupancy rate is now 102%. Up from 57%, right? So there's still demand. People are spending. People are going out. People are going to restaurants. It's a weird economy right now because we're seeing the standard quote recession, but then at the same time, this AI boom. But then at the same time, people are still oblivious to it and choose. It's almost like they choose to ignore it, even though there are some warning signs. Rates are really high, but people are still spending. Here's that TSA checkpoint travel number. Look at this. We actually made new highs for travel above the pre-pandemic.
It's wild. So people are spending. And I mean, we know that our economy is driven 70%, right? Is consumer spending. So is that why the economy is remaining so resilient?
That's exactly right. And as long as people are still spending and going out, it's delaying the recession, and it's strengthening that soft landing narrative that we could avoid the recession. So I didn't put those charts here because we spoke about them last time, but the saving rate is very, very, very low, and credit card rates are really high. So the consumer doesn't have as much cushion as in other periods of time. So that's what really worries me here as well. That if this really turns around and employment softens, because right now what's holding this together is people feel like they can spend because they're still employed and employment is really strong. But if this does start rolling over and translating into real full-time jobs and not just this temporary jobs and follows leading economic indicators, the consumer is not in the great shape because they are spending and they're not saving. They don't have a big cushion. So that is the big warning. So the question is, can they ward off the recession long enough? Would the Fed pivot in time? Will rates actually drop in a way that can sustain this? That's really the combination of factors. And that leads us to inflation, because that's really the going narrative. Is inflation going to really crash to allow the Fed to cut rates to keep this going?
Yep.
Right. So what you see here is that U.S. economic surprises did go towards the upside here, but mainly it came from inflation actually being stronger. And nowcast went down a little, but inflation has stalled. and it's far higher than the Fed's mandate. We're in the fives still. And inflation is coming down much slower, which now led the market to reprice additional rate hikes in June, and possibly another one in July or August. So there's now another additional rate hike or two priced in, as services inflation here in blue that we talked about quite a bit is just refusing to really go down that fast. So the narrative is really higher for longer, or even potentially higher than where we are now. And the question is, can the economy really sustain that for a long period of time, is really the kind of the $1 trillion question. So that was really it, with the exception of one bonus chart that I thought was really interesting.
Well, so just to recap before we get to the bonus chart, what's interesting about what you just said is it kind of runs contrary to everything that you were saying earlier about, that the Fed is going to need to pivot because this massive drain on liquidity is, which is, I wouldn't say unprecedented, but it is very rare, especially at the rate that we're expecting to see it.
Right.
We're going to be having that taking place, and the market is expecting maybe even more hikes. And yet, it seems like we're setting up for a perfect storm, especially if people are spending so heavily into it and they're not sort of keeping savings set aside to take care of themselves through a crisis. That is concerning.
That's why I told you early, there's so much to discuss, and 2023 is so interesting, because really it's a tale of two economies in a way, right? We have the Russell 2000 doing nothing or literally going lower, and we have everything propped up by 7 companies, and investors don't seem too concerned. Volatility is priced really low. I mean, the VIX is priced at only 16 or 15, allowing you to get really cheap hedges in case things do go lower. But what's interesting, that happened in 2008 as well. People don't realize this, but June 2008, the VIX was trading at 16, just 3 months before the world blew up.
This is the literal calm before the storm.
It's not uncommon. But what I would say, again, you don't know how this is going to pan out, because if we do see this huge liquidity drain, it could kill inflation. We just don't know. Yeah. How ingrained is inflation? There's just so much uncertainty right now. It's actually, I would say, one of the most uncertain macro environments I've ever seen. Possibly it is the most uncertain macro environment I've seen, because you do have a lot of conflicting indicators, and a lot of them are pointing far lower, but at the same time, it just refuses to let go. And you have a mini bubble forming at the same time with the whole AI narrative. So it's just super interesting.
So hit us with the bonus chart. What do you got for us?
Bonus chart related to housing, which is something that a lot of people obviously care about a lot. It is currently the most expensive to buy versus rent it's ever been in America.
Wow.
And you can see that because prices really haven't come down that much, but you're at 7% mortgage rates, which therefore the spread between buying and renting is absolutely huge. Because again, landlords can't raise rents nearly as much because people can't afford to do it. And typically those that can purchase can buy more. But at the same time, because employment is still strong, and because rates were so low just, very not that long ago, most owners have 2 and 3% mortgage rates. So they have no incentive of selling or leaving their existing home. So there's very little inventory. And at the same time, buyers can't afford to buy because mortgage rates are so expensive. So it's a very weird situation that, something's got to give. Either price is going to go lower or rates are going to go lower. But currently it's a very unique situation.
Yeah, no, it is pretty wild. And we were already, America was already looking like a nation of renters, but when you have a divergence like this, it's not even a question, right?
Right. And technically, when the cost to buy, like it was between 2009 all the way through 2019, when the cost to buy is lower than the cost to rent, you should typically just, you should buy, or even when it's slightly above it. But at this point, it's very difficult to make that type of decision when renting is just so much more affordable.
Yeah. Wow. Well, you were right. This was action packed, and this gets me excited for the next time we check in with one another and we get to look at what the news doesn't tell us, but what the data does. Thanks for such a comprehensive update. And thank you everybody for joining us. We'll talk to you again soon.
Sounds great. Catch you next time.